Okay, it's 10:01 and we are going to get started because we have a hard stop at 10:30 Eastern Standard Time. So good morning. I don't know if y'all can see me. You really don't need to see me, but my name is Laura Peary and I am a National Long-Term Care Plan Specialist. Our agency helps people with long-term care planning, with Medicare planning, with retirement planning. We help people set up personal pension plans. Usually, our goal with that is A, to protect qualified assets from market risk, and B, we can set it up for a joint payout, lifetime guaranteed, and C, in the context of long term care, we can have your income double if you need long-term care assistance. But we kind of do it all. We take advantage of every spoke in our wheel of a 215 license. And our goal is to be advisors, not order takers or enrollers. We're really looking at being comprehensive in our recommendations and strategies, keeping in mind what your goals are, what your budgets are, what your budget is, and what your resources are. Um, as you probably know, if you know anything about me, I'm endorsed by this guy named Dave Ramsey. That connection was a series of meeting people who introduced me to people who introduced me to people who introduced me to the Ramsey solutions. And I really trust his process and his recommendations. He's helped a lot of people. One of his recommendations as we plan for retirement is to protect our wealth and our quality of life with a long-term care policy. We're talking about not just wealth span. Yeah, we're talking about wealth span. How long is our money going to last? But we're talking about lifespan and we're talking about health span. And really, the bottom line is, if we're healthy, we could live a long time. And if we live a long time, we may need some type of assistance. Now, that's not necessarily nursing home. In fact, what we say is we help people with nursing home avoidance, not nursing home insurance. Yes, our policies will pay for nursing home, skilled nursing, if that becomes a need. But really, if we have a plan that's going to pay for our medication management, that's going to cover our fall risk, that's going to help with hygiene and nutrition, most people are less likely to have to go to a facility at all. And that's what we're trying to avoid, to have a quality of life, even if we need assistance. This is just my attempt at AI, what it looks like as we age to have a policy and what it looks like not to have a policy. And really, this is a conversation that's a family conversation. It doesn't just affect me. It doesn't just affect my spouse, although I don't have a spouse. Um, it affects my children and it affects anyone who's going to be involved in that journey of longevity. The I talk to so many people who have walked through this journey with a spouse or a parent or a loved one, and the risk is catastrophic. It's not just a financial drain, but it's an emotional drain. A lot of people assume that Medicare is going to take care of them. That is a wrong assumption. It's one I made myself years ago. The bottom line is the most that Medicare will pay for long-term care is 100 days of skilled nursing if you're even eligible for that. The way you're eligible for that is if you're continuing to improve, because if you're not and you're this is as good as it gets, they kick you out and send you home. So after that, we are completely self-funding this risk. It's not unlike saying, well, if my house burns down and I've got a $750,000 home, I'm just going to pull money out of my savings or my retirement to rebuild my house. The problem with that logic is that the risk of needing some type of assistance is enormous, especially as we get older. Social Security, just by the way, was designed. I don't know when it was designed, but it was designed to for people. They were expecting people to live until age 64. They weren't expecting us to live as long as we are, and we just keep living longer. The cost of care, when we talk about the money going out the drain or over the cliff, can be catastrophic. Now, there is a chance that we will need nothing. There's a chance that we'll die and go straight to heaven and we won't need anything. But if we have any longevity in our future, in our family, the risk is significant, especially for women. This is a catastrophic conversation for women. This is a calculator worksheet that I use. What we do is we consider the cost of inflation, and right now the cost of care is about $9,733. Now I have clients coming to me saying, "Oh no, my mom's paying more than that." Yeah, probably in some places you are, but as an average across the country, that's kind of a reasonable number, give or take. This is an estimate for a couple that's 55. Their odds together of needing some type of assistance is 80%. And together, there's an 80% probability that they're going to need $1,454,000 to cover the cost of their long-term care not covered by Medicare. The government is real serious about this conversation. In fact, in 2021, they passed the Washington Cares Act in the state of Washington saying if you don't have a long-term care policy, you get to pay another 6% tax. And we don't all live in Washington. That's not the point. The point is that the governments are starting to recognize that they can't pay for this. It's a problem where people assume that Medicaid is going to pay for them, and Medicaid is a limited resource only available to people who have basically impoverished themselves. In fact, if you're relying on Medicaid as a resource, the most that we can keep is $2,000. If you're married to someone who needs assistance with activities of daily living and they want to go on Medicaid, the most a healthy spouse can keep is one house, one car, and $162,660. Everything else must be spent for the benefit of the spouse that's sick before they're even eligible to apply for Medicaid. And the most that you can have an income is $2,982. So most people I talk to, they have more than that. They have more than that in assets, and they have more than that in income. This is a calculator. If you'll look in the chat, there are some resources there. There's a life expectancy calculator. There is a cost of care calculator, so you can put in your zip code to see what the cost of care is today and what it's going to be in the future in your area. And there's also a questionnaire that will give us some feedback about what type of policy that you might be eligible to consider. This is my life expectancy, and I joke that I would need to find a rich man to help me pay for living that long. But at the end of the day, we are living longer. In fact, there are, I think, 197,000 centenarians in the United States today. And most of them are women. By 2050, there's a projection that there are going to be 600,000 people that are living up to 100 or past. So that's pretty startling when you consider that the resources planned to take care of us by the government were only expected to last until age 64. So the point is there's a gap. Most people are more afraid of running out of money than they are of dying. That's why we use guaranteed income pension plans. That's why we use long-term care, because if you're relying on your goose, your bucket of money to create income for you on dividends or earnings, and you have to start pulling out an unexpected 20 grand a month, your goose is going to evaporate. Most people in a survey in 2018, I don't know where it is today, said that long-term care expenses were their greatest concern. It's not the golf course that they retire next to. It's not inflation. It's not even leaving an inheritance. But how are we going to take care of each other? How are we going to take care of ourselves? Really, what we talk about when I meet with clients, we talk about as an advisor, not just what policy would be appropriate for you, but what is your plan? Is your plan to stay at home? Is your plan to have your kids participate or not? Most people say, no way. I say, I don't want my son to give me a bath, but really, what is the plan? Do you live in a one-story house? Do you need to make, a downsize? What does that look like? So we look at it from a comprehensive, holistic approach. But the three ways that we pay for long-term care is either we write a check out of our own nest egg. Right now, if you don't have a policy, you are self-funding the risk. We can't say self-insure because you're not an insurance company with a pool of assets and resources to draw from. Basically, you're paying full price for whatever you need, as opposed to transferring the risk, or we say partnering with an insurance company. And we don't have to partner with an insurance company to protect all the risk, but we can certainly partner with an insurance company to protect some of the risk, just like we do with our homeowners, just like we do with our car, just like we do with our health. The The idea is let's talk about what is reasonable to consider. So is it reasonable to consider that as I age, I'm going to need some kind of help? Yeah, it probably is. Is it reasonable to consider in most cases I probably want to stay home? Yes, most people want to stay home. Now, I do have some people say there's an assisted living down the street. They have happy hour. They have field trips. I want to go there. It's $24,000 a month. Can you help me get into that? Yes, I can. If you're eligible to apply. Um, but would you agree that even if your spouse could lift you today, can they lift you? Can you lift each other when you're older, when you're 80? The answer to that question in most cases is even today, I can probably drag him, but I can't lift him. Transferring is one of the ADLs that we need assistance with. And then can we agree that it's reasonable that we want our children to be standby, not hands-on caregivers? In other words, our children, our grandchildren can supervise the caregivers. The point is that the consequences are catastrophic of not having some type of a plan that in most cases may include a policy. We're talking today about the three pillars of our retirement planning. We've got three of them. The first one is our financial advisor. They're wonderful. They're there to help us grow our wealth, to defer our taxes, to protect from market volatility. Generally, those guys have securities licenses, and they're really good at managing market risk and all that stuff. Sometimes they play in the sandbox of other things, but for the most part, they're really good at doing what they do well, and that's growing our money. Our estate attorney, they're really important. That's another pillar that we want to make sure that we have a proper wealth transfer plan. Now, as an advisor, I tell my clients, I don't really care about your will. I don't care where your stuff goes. What I care about is what happens while you're alive. Do you have a financial power of attorney? Do you have a medical power of attorney? Do you have a pre-need guardianship document? Do you have those documents that are going to help you when you need help? When my husband was sick, if I had not had a power of attorney, I could not have spoken to the bank. Even though I was married, I couldn't have talked to his job based on certain things related to his job. I had to have that power of attorney. So never assume that just because you're married, you can navigate those concerns. The most important pillar in this plan is your health plan. Whether you're aging into Medicare and you need to find the right Medicare plan that's going to last not just today, but that's going to be meaningful when you really need it tomorrow. But the long-term care plan that Medicare doesn't pay for, Medicare does not pay for long-term care. If we as advisors, and that's where we're in the health planning pillar, if we as advisors don't help our clients properly design this pillar, the other pillars will crumble. Your best financial plan is not going to be of any value if you start taking money for needs that weren't accounted for. And your best estate plan is not going to be of any value because you're not going to have any wealth to transfer because you spend it all on long-term care. So that's really what we do as advisors is we help mitigate the risk, maybe not fully protect it. We do what we call a hybrid planning, not a policy, but a hybrid plan. What that means is if the cost of care is $12,000 a month and you have a policy that's going to pay 10, you're okay with coming up with $2,000 a month. That's a little bit of self-funding, but you're just not taking on the full risk. And that's part of what we help people design. So what happens when we don't plan the health is that our retirement income gets redirected to care expenses. Our assets are liquidated unexpectedly. Our family members now become caregivers. Our estate plan unravels and stress replaces stability. When I help people enroll and get approved in a policy or a plan, there is a sigh of relief because not only do they know that they have this risk protected, but now they can enjoy the rest of their wealth. They don't have to hoard it just in case something happens. So why work with a certified long-term care specialist? Well, one, we as specialists and agents, we have contracts with all the different carriers. We're not captive. So if you sat down with an agent that was captive, they can only show you their stuff. We have access to all the top rated carriers to show each person what they're eligible to apply for and consider. And we talk you through what Medicare spend down looks like. We talk you through the different way that benefits are paid, whether it's cash or reimbursement, whether you want to have a shared care policy, what a waiver premium looks like. We explain what an elimination period looks like. We explain how a partnership qualified plan works, the way the governments work with the departments of insurance for each state. We get into all that nitty gritty so you understand how it all works together. And this is just a picture of some of the carriers that we work with. But there is not one size fits all. Sometimes I got an email from a client last week that said, "Thank you for being so creative in your strategy to help me design this policy." And at the end of the day, my clients help me figure strategies too, in terms of bundles and strategies and that kind of thing. So we have great strategies and great solutions. Today, we're going to talk about the long-term care annuity, but we have a personal pension plan, which requires no underwriting on the medical side. We have what we call short-term or extended care policies that have modest underwriting. We have a hybrid policy, which will pay to your estate a death benefit if you don't use it. A lot of people like that. And then we have a traditional long-term care policy that also can pay a return of premium, but it's a comprehensive benefit pool that will protect the risk. The bottom line is this: underwriting, underwriting, underwriting. We have our underwriters on speed dial because the last thing we want to do is just throw it up and see what sticks. We're very meticulous about asking for information on the front end so that we have permission in some cases to even apply. The point is this: you can't just go out and buy this, and I can't just sell it. You can't go online and Google, long-term care, let me enroll. We have to go through an underwriting process, and that's where we are the advocate for our clients. We don't have an allegiance to one particular carrier. Dave Ramsey doesn't pay us. We only get paid if we find a solution that works for our clients, that makes sense for them, and it's not the client that pays, but the insurance company. So today we're going to talk about how can an annuity with a long-term care writing cover this gap. The people that want to talk about this solution are people that have an asset or balance sheet mindset as opposed to an income and expense statement. And by that, I mean this: when you have an annuity that's going to have a long-term care rider, you're just repositioning your money, but you're going to have some significant leverage for the cost of long-term care if you need it, and access to cash if you want it, and a death benefit if you don't need long-term care. So that's why the solution is important for some people. It is a single premium deposit. The idea is, how will the long-term care need affect our retirement? The reason that people need long-term care, these are all from the Equitrust Bridge brochure. It could come as early as tomorrow. This is not just an aging conversation. This is an aging health injury conversation. So we know people in the news that have had a diagnosis of dementia young. We probably know people that have been in accidents and have been paralyzed. So it's anyone who needs some type of assistance with activities of daily living, cancer, all of that stuff. Long-term care expenses can include home health care. That's really the goal for most people. Assisted living, adult daycare, medical equipment that's not covered by Medicare. Home modifications is a nice benefit if you need ramps and rails and walk-in tubs and all that stuff. There are benefits that can be allocated toward that. And then, nursing home, if that's what people need, it's there to help pay for that. Basically, with an annuity, it's a single premium account that is leveraged with a long-term care rider. It's in some cases, the annuities are what we call fixed, meaning, first of all, your money is completely safe. You're guaranteed never to lose any money. If it's a fixed annuity, you've got a fixed interest rate that grows the benefit pool. If it's indexed, it means that there's an index to the S&P 500, not invested in the market, but indexed and tracking with the growth for the benefit pool to grow. The taxes are deferred generally in annuity, but with a long-term care annuity, not only are the taxes deferred, the benefits are paid tax-free. So that's what qualifies long-term care annuities as 7702B long-term care policies, is that they have the provisions dictated by the departments of insurance to make sure that you not only are going to have tax deferred if you move money in, but if you need long-term care, that money is coming out tax-free. So if you're getting $10,000 a month, you're getting $120,000 a year in cash. In this particular case, this annuity pays cash. That's all coming to you tax-free. And really, we're talking about leveraging and what would happen without an annuity with our money. Basically, we'd have to pay taxes on it if we just took it out of qualified accounts. When we reposition it to an annuity, we have the benefit of the tax defer tax-free. The other thing is that some people have what we call lazy money, lazy annuities, maybe a cash benefit in a life insurance. We can help assist in a transaction called a 1035 exchange, meaning we just reposition the asset from one account to another. And the point of that is leverage. We want to get a lot more leverage from the policy. Again, most, if not every carrier has some type of underwriting. The reason that people like this strategy is one, they're getting it taken care of. Two, they're going to have indexed growth in their benefit pool. Three, they're going to have a death benefit that's going to grow if they don't use it. And four, underwriting is really easy. Underwriting is a video interview where you have to demonstrate that you can stand up from a chair without using your hands. They're not going to ask you if you have cancer. They're not going to ask you if you have Parkinson's. They're not going to ask you any of those deep dive medical underwriting questions for this account. So, whether or not that's important to you, the people choose this option for other reasons besides underwriting. But when I have somebody who's got some underwriting challenges, they've got some wealth that they want to reposition, this is kind of a no-brainer. This particular account, this is a sample of a guy named Derek who put in 100,000 when he was 55, and his benefit base 15 years later was $506,000. So that just shows you the leverage that you can get by not just counting on that $100,000 to be paying for long-term care, but how the leverage works toward the benefit base. The other thing about this particular account is it has what we call wellness credits. So what that means is that twice a year, you participate in coaching. And it's really about keeping active, keeping social, guided and aligned with your goals. If you like to garden, if you go to a bridge club, they just kind of check in and help you stay and continue to stay active in a wellness plan. And you get credit for that. In this particular case, you can see that Derek got almost $50,000 in his wellness coaching credits, taking his benefit base to $554,000. His guaranteed monthly benefit for long-term care is $9,200 a month for 5 years. There's no investment that you can put 100 grand in outside of an annuity like this with a rider that you're going to get that much leverage for the purposes of long-term care, especially coming out tax-free. This is the Never Stop Wellness Coaching plan that I just think is wonderful. It's just really personalized, like I said, and it helps people that want to stay healthy add benefit to their contract. The next step for you is there's a document in the chat. If you'll all take a look at the chat, there's a document that's an aging plan document. There's a link to the longevity test. There is a link to a medical questionnaire that helps us as field underwriters help you decide what strategy may be for you. It may not be this annuity, but what we sometimes do when we look at all of our options is we say, well, we've got some different options where this is a no, this is a no, this is a yes. And everyone's different. I can never tell what people are going to need or qualify for. So I take the time, and believe me, it takes time before I even meet with someone to have some quotes that are appropriate for them based on their underwriting concerns. And then schedule an appointment. It's lauraperryagency.com/book online. And we as a team will work with you to help you find the most appropriate strategy to protect this risk of long-term care. Thanks for coming. If you would like a recording of this video, just send me a quick email. I can also send you the documents in the link, and we can go from there. I'm happy to send a copy of the recording. Everybody have a great weekend, and I finished 5 minutes early. My next seminar is going to be May the 9th, and I think we're going to talk about the hybrid strategy using a company called Nationwide. and One America. Those two, we're going to look at a side-by-side comparison of Nationwide and One America. They are different in the way they behave, but they're both hybrid policies that are A-rated companies, and there are good solutions for some people who A, want a lifetime benefit, or B, want all of their money coming to them in cash. So everyone have a great day, and thanks for coming. Bye.